Now, we don't know what length the next cycle is. It depends on where they refinance this entire cycle at. But right now, we know we've probably got an ISM and a business cycle that extends well into late 2026, and that will affect asset prices. So this is why markets have been acting, well, crypto markets have been more subdued than people expect. The other thing is interest rates. Interest rates haven't needed to yet come lower, but now we're seeing the urgency from Scott Bessent, who understands the everything code, and Steve Mirren and Trump all saying we need to get rates lower. Why? Because we've got $9 trillion of debt to roll over the next 12 months. It's this 12 months that is the key to everything. It's this 12 months where maximum money printing.
The global economy is running on borrowed time. Each new wave of debt, liquidity, and interest rates builds upon the last, creating both enormous risks and rare opportunities for investors who understand how the system works. At the heart of it all lies what Raoul Pal calls the Everything Code, a framework revealing how demographics, debt, and productivity quietly shape global markets. While Pal expects the current cycle to stretch until late 2026, he warns that rising government debt, aging populations, and slowing productivity are steering us toward an unavoidable reckoning in the early 2030s. To keep the system afloat, central banks are trapped in a cycle of endless liquidity injections and hidden debasement. This means one thing for investors: only assets that can outpace this erosion of value will survive. Liquidity, not fiscal policy or politics, has become the dominant force driving markets, influencing everything from equities and bonds to crypto. As money continues to lose value at a structural rate of 8–11% per year, understanding this dynamic is no longer optional, it's essential. In today's video, we'll break down Raoul Pal's latest Everything Code Masterclass. He explains why diversification no longer offers true protection, how liquidity cycles now control every asset class, and why the next 12 months could unleash the largest wave of money printing in history, reshaping global markets and redefining how investors position their capital. Cybercriminals are getting smarter, and everyday investors are the new target. You worked hard for your crypto. Don't lose it to a scam. Recently, attackers bribed offshore agents at major crypto platforms, stealing names, birth dates, even social security numbers. They drained real accounts in seconds. No blockchain hack, just human error. Once it's gone in crypto, it's gone. That's why ITrust Capital created the Premium Custody Account, the most secure way to protect your asset. It's a closed-loop system, meaning funds can only move between you and your account. Even if someone gained access, they can't steal your crypto. Backed by institutional-grade custody at no extra cost. Sleep easy knowing your investments are locked down. Click the link, use code DOSE7, and get a $100 funding bonus. Start protecting your future with ITrust Capital.
The key thing, I've been an investor for a long time, as has Julien, and we've run diversified portfolios. That's what we've been taught to run. We now believe that diversification is dead, and the best thing is hyper-concentration, which goes against what many, many people will tell you, but will explain why. And it all comes down to the biggest macro variable of all time, the most important. And I'll explain why this has happened. But what the issue is here is the global governments and central banks are increasing liquidity to manage debt at 8% a year. 8% a year is actually the devaluation of fiat currency that you don't see. It's kind of hidden, and we'll come into how it's hidden later. But this 8% is your hurdle rate to your future, plus you need to add inflation. Yes, it's in addition to this, because inflation is not the same as debasement. So you've got an 11% hurdle rate on any investment that you have. And once you understand this, it changes what you do with your money. Because don't forget, an asset that you buy is future deferred consumption. Some point in the future, you want to release that. And because you've locked money up for an extended period of time, you expect to be rewarded above what is happening to debasement or inflation. That is the whole point of investing. Now, what is happening is most things aren't doing that. We'll come into that. So anyway, just remember this, 11%. If your investments are not hitting 11%, you are getting poorer. Okay, the everything code. It all starts with this, the magic formula. The magic formula is how you think of trend rate of GDP. It's actually driven by population growth, productivity growth, and debt growth. Those are the three key factors that drive GDP over time, and it's consistent everywhere in the world. So let's start looking at these. Trend rate of GDP has been falling over time since the 1950s and is now around 2%. Okay, so why is that? Well, the working age population has also been falling. So the working age population means that it drives less economic activity. So the trend rate of growth there has been falling too. Also, productivity has been falling over time, which is extraordinary considering the technology revolution that we've had. It has not driven productivity as much as it could have done. Yes, the measurements aren't great, but also it's a factor because of an aging population, and we'll show that shortly. Debt growth. Well, debt growth appears to have peaked back in, let's say, 2009. We had the pandemic spike, but really it has been trending higher over time, and the structure of debt has changed over time. You see, private debt, the private sector has been deleveraging. It's now down to about 100% of GDP. Total debt is still about 340% of GDP. When we get to private debts, it's about 120% of GDP and has been falling, which is good. But total debt has offset it, the public debt. The government has actually taken on the debts as the private sector's delevered, because it's trying not to let the deleveraging slow down GDP any further. It has increased debt. Okay, so that's how the three dynamics play out. But let's look at the most important one of all, demographics. Demographics is the basis. When I first started GMI, the first article I ever wrote was Debt, Demographics, and Deflation. And that has been my framework ever since. So let's understand demographics. The US birth rate per 1,000 people has been collapsing over time. It is more pronounced in other nations. It's definitely more pronounced in Europe, China, Japan. So the Western world has basically the same issue, which is the growth of population, which drives GDP, has been falling. And that means that we can forecast into the future because we know when people become labor force participation rate, or they become part of the labor force. Now, for some reason, it's a 16-year lead. Maybe you could shovel it and make it 18-year lead. But really what we find is that demographics are destiny. They forecast where the labor force participation rate is. The labor force participation rate is the key thing for economic activity. So what we've got ahead of us is a trend rate of labor force participation rate declining. And what this chart shows, this is like the most important chart of all of macro, and I've never seen it produced anywhere else ever, because I don't think people understand it. This is the chart of the labor force participation rate versus government percent of GDP inverted. So what it shows is trend rate of GDP is basically offsetting the labor force participation rate fall as the population ages out. That is why we have a debt problem. That is why government spending is so hard to manage. It's because we have this aging population. That is the key to everything, and it's only going to get worse because of this. So this suggests out into the future, debt keeps going up. Now, the economic singularity will change this at some point, but we've still got this collapse in the labor force participation rate to deal with into 2030. And that's going to drive massive increases in debt to GDP. You see, these are in perfect mega trends. The labor force participation rate is in a beautiful log regression channel, and we should just move towards the bottom of the channel and beyond in the coming years. And the reverse of that is the government debt percentage of GDP. You can see them pretty clearly, the trend. Now, the next thing that we found that nobody else has found is that Fed net liquidity, which is the use of the TGA, the balance sheet, and the reverse repo, has been the main mechanism for financing the debt. So they're joint at the hip. And so what they're doing is using liquidity to finance debt. If we do this on a globalized level, it's actually global total liquidity that is the real answer to all of this. But that you show how close that correlation is. Yes, the axes are different log scales, etc. But honestly, don't mid-curve it. This is the key thing. They're using the balance sheet plus any monetary tools possible, including the banking system, to pay for the interest on the debt. So you can see total global liquidity, they've started using the banking system as part of this. So that's why we've started switching our key measure to total liquidity, not Fed net liquidity, because it includes M2 and other measures. And you see what's happening there is it is starting to rise, as is the debt to GDP again.
What Powell reveals in the first part of his thesis is nothing short of staggering. He argues that the traditional concept of diversification has collapsed under the immense weight of global debt and liquidity. With fiat currencies being quietly debased at around 8% per year, and inflation piling on top, investors now face a minimum hurdle rate of 11% just to maintain their real wealth. As a result, Powell advocates for hyper-concentration into assets capable of outperforming this hurdle, rather than clinging to diversified portfolios that are steadily eroded by the system itself. This is where the everything code comes into play. Powell breaks it down into three core variables: demographics, productivity, and debt growth. Demographics drive the labor force, productivity ideally boosts output, and debt growth fills the gap when the other two fail to deliver. But today, with working-age populations shrinking and productivity stagnating, even amid technological innovation, governments have increasingly relied on debt to sustain GDP growth. Crucially, this expanding debt is funded through liquidity creation, effectively linking global markets directly to central bank balance sheet. And that dependency leads us to the next critical challenge: interest payments, the growing cost of maintaining this debt-fueled system.
What's interesting is when we look at the interest payments, you can see that it's the liquidity that pays the interest payments. The interest payments, because interest rates are above trend rate of GDP, that needs to get monetized because there's not enough economic activity. If the trend rate of the economy is, let's say, 2% and rates are at let's say 4%, well, that's double the amount of economic growth to pay the interest. We don't have it. The government's 100%, 120% in debt, and the private sector's the same. So there's just not enough economic activity to pay the interest on the debts. So this is why they debase currency. It's the story as old as the hills, but it is incredibly important to understand. Try not to mid-curve this and overanalyze this, because this is what is going on. Why did it happen and why is it happening? As I said, it's not the first time it's happened. It's actually happened in the 1950s and it's happened in the past too. But to understand it all, you'll understand that since 2008, everything became ultra cyclical. Before then, we had a business cycle that shifted a lot. It wasn't as clear. There was much more diversification in investments. But since 2008, everyone's like, oh my God, everything is a bubble all the time. And it's all driven by this one thing, the servicing of the debt. You see, back in 2009, well, 8-9, every major government around the world gave themselves a debt jubilee. They paid zero interest on any debt. And most of the private sector got to zero interest as well. That allowed everybody to restructure debts. The private sector has been paying it off. The government has been increasing to offset that. But what they've done is they've created a 4-year cycle, or they had created a 4-year cycle. We'll come on to the shift in that cycle based on the debt refinancing cycle. So it's about a 3 to 5 year sector is where they've been operating at. And every 4 years, they've been basically refinancing that debt by printing money. And that happens over a 3-year period. And then there's usually a period where they withdraw money from the system before they start again. But each time it keeps going up. And that creates these weird cycles. So Bitcoin, some people thought it was the halving cycle. It's not. It's the debt refi cycle because it happens in all assets, the NASDAQ, commodities, everything.
Here's where everything connects. With interest rates now sitting above the long-term GDP growth rate, there simply isn't enough economic output to service debt naturally. Governments are left with one option: monetize the debt by printing money to cover rising interest costs. This pattern has repeated throughout history, but since 2008, it has evolved into an ultra-cyclical system driven by powerful liquidity waves that now shape roughly 4-year market cycles. Stocks, commodities, and crypto, especially Bitcoin, all move in sync with these waves of refinancing and money creation. What's unique about the current phase is that between 2021 and 2022, governments quietly extended the maturity of their debt, stretching the traditional cycle and likely pushing its peak into late 2026. While that bought some time, it also intensified the pressure. With $9 trillion in debt due to roll over within the next year, the need to cut rates and inject liquidity has never been more urgent. And when liquidity floods the system, history shows that scarce assets like crypto tend to outperform. For investors, the message couldn't be clearer: if your portfolio isn't built to withstand the structural debasement of fiat currencies, you risk falling behind. Hyper-concentration into assets that can consistently compound above the hurdle rate is no longer a bold move, it's a survival strategy. Powell's framework points toward a future defined by rising debt, endless liquidity, and a steadily eroding currency system, the exact conditions Bitcoin was designed for. The next great liquidity surge isn't a question of if but when, and according to Raoul, the biggest beneficiaries are hiding in plain sight.